You're shopping lenders, you're looking for the best possible interest rate, right? Well, who isn't? And you're hearing this word, discount points. Discount points. Now, you might be getting told by your family members, never pay points when you're getting a mortgage. Well, I'm going to teach you all about points. And most importantly, how do points work? Can you negotiate points? Can you buy points after closing? Are points tax deductible? And should I buy points? And on top of that, stick around for the end of the video because I'm going to give you a bonus on how to have someone else cover those points for you. Now, let's talk a little bit about how points work. How do points work? Well, discount points or points are fees paid in advance to buy a lower than market interest rate. It's really prepaid interest, but in essence, you're paying money up front to get a lower interest rate for the life of the loan. One discount point equals 1% of the loan amount. So let's just keep simple math. You have a $400,000 property, or sorry, $400,000 loan amount. You pay one discount point. 1% of $400,000 is $4,000. So I get this question from a lot of buyers and even realtors, and they say, how much does a point cost these days? Well, a point is always the same as far as a percentage is concerned. 1 point is 1% of the loan amount. But the cost is going to vary depending on what that loan amount is. The higher the loan amount, well, the more your point would cost, right? Now, the reason you're paying points in the first place is to lower your rate, but what you're really doing is you're lowering your monthly payment. So you need to determine when it makes sense to pay points. Now, can you negotiate points on a mortgage? Well, of course you can negotiate points on a mortgage. Points aren't something that you're required to pay. It's up to you to decide however many points you want, if any, to be applied toward your interest rate. You can do no points, you can pay 3 points. It really depends on you and what your overall goal is with the home purchase and how much money you're comfortable putting toward that purchase on top of your down payment. Because like I said, points are cost up front toward the purchase of the home. More importantly, toward the cost of the mortgage. On average, one discount point is going to save 0.25% on the interest rate. Now, this is an average. It can vary depending on the market. In today's market, it's a little crazy. 1 point can save a full percent on your interest rate. However, in a normal market, paying one discount point typically reduces the interest rate by 0.25%. It doesn't reduce it by 1%. That's a common misconception. People think 1 point is 1%, meaning it reduces the rate 1%. That's not the case. 1 point typically saves 0.25%. So if you were able to get a 7.75 with no discount points, your rate would be 7.5% if you paid one discount point. If you paid 2 discount points, the rate would likely go down by 0.5%, and so on and so forth. Now, can you buy discount points once you've closed on your home? No, you can't. So you need to determine whether or not you want to pay discount points prior to closing on your home. You can't decide a week after you closed on the property, you know what, I wish I paid the discount point that I discussed with my lender. No, you can't go back in time and do that. You need to make this decision up front. This is part of reviewing the costs on your loan estimate with your lender up front. And if you want a video that details how to review a loan estimate and understand all the costs involved with your home purchase and your mortgage, including discount points, make sure to subscribe and watch my video that specifically walks you through the loan estimate and where these discount points would appear. But back to this, you cannot buy points after you close on the loan. So it's important to weigh all of your options before locking your interest rate and choosing the loan you want to move forward with. Now, Are mortgage points tax deductible? Yes, they are tax deductible. And the reason they're tax deductible is, like I already mentioned, discount points are really interest that you're prepaying on the mortgage. And mortgage interest on a primary residence or a secondary residence, like a vacation home, is tax deductible. So therefore, discount points are tax deductible. You'd want to provide your accountant with a copy of your closing disclosure from either your purchase or your refinance, whatever it was, and whenever you paid your points in that year, so they can write that off for you on your tax return when you file. Now, it could give you big tax savings. Let's just say you paid $10,000 in discount points when you obtained your mortgage, and maybe you're in a 25% income tax bracket. Well, you're actually going to reduce your taxable income by $10,000 because you're writing off the $10,000 in discount points. So 25% of $10,000 would mean that you have $2,500 in income tax savings. So although you paid $10,000 for the discount points at the time you obtained the mortgage, your net cost on that technically is $7,500 because you're saving, in this example, $2,500 in income tax. That's money that you kept in your pocket because you paid these discount points. Now, should you buy points? That's the most important question you need to ask yourself, and you need to ask your lender, because not everyone should pay points. Sometimes you need to pay points to buy a lower than market interest rate to make the numbers work on a specific property, because maybe your debt to income ratio, meaning the amount of money you make on a monthly basis compared to your expenses on a monthly basis. Also, another video I've done that you might want to check out, how to calculate and determine your monthly expenses and what lenders look at when calculating your debt to income ratio. So make sure to subscribe or comment below. I follow those comments in real time and I do reply if you have questions on your specific scenario. However, should you pay discount points? And like I said, it really varies depending on the individual. If you don't need to pay discount points specifically to qualify, there's other things you need to look at as to a reason to pay points. For one, you need to determine how long you plan to keep the mortgage. And the reason I say that is because you need to determine your break-even point. You're going to pay money up front. That money's going to convert to savings on a monthly basis. But how long will it take to recoup that upfront cost based on the monthly savings? The only way to know whether or not you're truly going to benefit is to know how long you plan to keep that mortgage. The shorter amount of time you plan to keep the mortgage, the less likely it is that paying discount points would make sense. Now, I'm going to give you an example on whether or not the monthly savings would justify the cost. Let's just say you paid $4,000 in points, and that's saving you $200 per month. Well, we need to determine what your break-even period would be. And the way we do that is we take your cost of $4,000 and we divide that by the savings of $200 a month. 200 divided into 4,000 is 20. What 20 represents is the number of months that it's going to take you to break even. So if I were your lender and you told me, Brandon, I plan to stay in this property or keep this mortgage for 16 months. I get transferred often for work, and it's likely I will not have this home or mortgage longer than 16 months. And this was your scenario, and we did the math, and we determined it's going to take you 20 months to break even on paying $4,000 in discount points. I would advise you not to pay the discount points. And the reason being, you're only going to be there 16 months. You would never recoup the cost. So although it would feel good on a monthly basis because you're paying $200 less per month, well, your overall cost in the time period that you actually had the mortgage wouldn't justify the cost that you paid up front. Now, if you plan to keep the property 5 years or the mortgage 5 years, and you said, Brandon, I'm going to definitely keep this mortgage 5 years. I'm not going to refinance. I'm not going to sell the property. I would say absolutely pay the discount point, because it takes you 20 months to recoup and you're technically saving for the remaining 30 months of the 40 months of the 60 months you plan to be in the property, right? That's $8,000 in savings. That's 40 months times $200 is $8,000. So you're saving more money than it's costing you, substantially more actually. So it makes perfect sense for you to pay discount points in that example. So like I said, how long do you plan to keep the mortgage is one of the most important questions you need to ask yourself and your lender at the time that you're determining whether or not points are something that you want to pay. So you're paying interest up front, as I mentioned, in exchange for a lower interest rate. The only time that does make sense, even if the break-even period isn't going to make sense, is if you need to do it to qualify for the property or the size mortgage that you're looking for. Now, I said I'm going to tell you how you can get the points paid for by someone else, right? Maybe you don't have the money, the extra money to pay discount points, or you just don't want to pay the discount points. Well, you can get this paid for in the form of seller credits. Seller credits are funds that come from the seller of the property that can be used toward your closing costs. Discount points are part of your closing costs if you were to pay them. And since seller credits can cover closing costs, seller credits can cover discount points. Now, the amount of a seller credit that you're allowed to get varies depending on the type of loan you're obtaining and your down payment. So as an example, if you're getting a conventional mortgage and you're putting less than 10% down, the maximum seller credit you're allowed to get is 3%. 3% of your sale price. So if you're buying a $400,000 property, 3% of that is $12,000 that they can contribute toward your closing costs and therefore toward discount points. So if you were to pay $4,000 in discount points and you get a $12,000 credit, it frees up another $8,000 that can go toward your other closing costs. But this way the discount points being covered by that seller. If you're getting an FHA mortgage, you're allowed to get up to a 6% seller credit, which is even greater. $400,000 property, 6% of that is $24,000. That can go toward your closing costs. Once again, toward discount points as well. You're allowed up to a 9% seller credit, maximum, if you had a conventional mortgage and you're putting 25% or more down. 9%. So the point being, don't let discount points or the word discount points scare you because your parents, grandparents, uncle, brother, friend who looked online told you not to pay discount points. There's different variables that would determine whether or not paying discount points would make sense for you. So it's important to know those things and speak to a mortgage professional about the discount points, run the numbers, do some comparisons, see what's going to work best for you before you make the decision on whether or not paying discount points is the right option. If you're currently in the market to buy a home or you're planning on buying a home anytime in the near future and you like videos just like this one, make sure to subscribe for more detailed information on things other than just discount points.